So while I think Feroze extensively explained of the objectives one needs to keep in mind while planning your investments and getting your financial plan in order, one of the most common elements in any financial plan, or one of those aspects or allocation of a perfect financial plan, would have a lot of allocation to mutual funds. Let's begin by talking about, do mutual funds really deserve the kind of importance they get? Because across the board, the chatter is mutual funds. More often than not, even the regulator wants most people to keep away from direct equity, choose mutual funds as a advisable sort of option to make investments into equities. So Amit, why don't you start with that? Do mutual funds really deserve the kind of importance that they do?
I think they completely do, right? So India has got a patchy history. We've had public sector funds where a lot of people didn't have great experience in the 80s and especially in the 90s. But I think in the last 20 years, since a lot of the private sector mutual funds have come, I think the track record and numbers speak for themselves. So if some of you remember seeing some chart over a 20-25 year period, a lot of these funds have given 20% to 25% annualized returns. And of course, the markets in India have done well, but they've given almost a 10 to 15% per annum return over and above the markets. So they've done an exceptional job. I think, we're also, we run a large retail brokerage operation, and I see a lot of individual investors who essentially trade over 2, 3, 4, 5 years and don't end up making money, and a lot of people end up losing money because, they're working on the basis of limited information. And I think if you see the example in the West, institutional investing is the best way to go forward. If somebody takes 1.5% but is actually able to deliver results, I think it's a great way to sort of participate in the equity markets. In our view, that's the preferred route to participate in the equity markets.
Is this an India-specific story, or are mutual funds a preferred route even in developed markets like the US for that?
In fact, in the developed markets, your retirement monies also have to go through mutual funds. So they have something called the 401k plans. In the UK, they have IRAs. And that money is not given to some government body like the EPF or whatever to manage money and put in government bonds. You can actually pick your own mutual funds. So there you would see mutual fund penetration as a percentage of GDP is 40%, 50%, 60%. In India, it's 3 or 4%. So mutual funds are clearly an established mechanism. They are well regulated, and in fact, costs are low. The regulators have kept on bringing the costs down. I think there is no better way right now. And globally, we have a roadmap, and these countries have had funds for 50 years, 60 years, 70 years. So I think it's a much better
We've got 400, if not more, mutual funds to choose from. Let's start by telling us, how do you go about choosing this? Do you go with the most famous fund house? Do you go with something your neighbor is invested in? Do you go with the most popular or highest return in the previous year fund? I mean, there are so many parameters that one uses. As retail investors, I know that process is far more cumbersome because you don't have access to information as much as, or advice, actually, not even information. So help us understand, with so much available in the market and so much changing so often and frequently, what are the sort of parameters one needs to look at to start this investment process?
I think it's like, therefore this layer between investor and a mutual fund, there's a role for an advisor. It's likewise, it's like having a doctor between a patient and a chemist. Most of us end up in India, we're so used to going to chemist directly and doing OTC medication ourselves. But in most cases, when you have a long-term chronic situation, it's best to use a healthcare sort of professional or doctor in between who has the ability to see the entire situation and advise. Now, how do you pick mutual funds? There is a lot of, sort of effort, science, statistics, knowing people who are involved in the fund management. And that's where, really today we have about 40 people dedicated just doing that on a full-time basis. And it's difficult to sort of sum it up in 2 minutes. But what I can say is the biggest mistake all of us make when we pick mutual funds is by looking at their past returns. It's like driving, looking in the rearview mirror, ki past mein kya hua. And I think one of the big exercises that at least what we try and do is predict who are the fund houses, fund managers who are likely to better over a 5-10 year period, meet the investment objectives that we have set out for them, who have consistency. And I can share one thing, that Feroze and his team have done exceptionally well. Something very simple. What does a fund manager do? Take decisions, buying and selling. One of the simplest way any investor can evaluate a mutual fund is look at how many decisions have they got right and how many decisions have they got wrong. It's something called, we call a right to wrong ratio. So if today I have a fund manager who has taken 100 decisions in the last 5 years and he has taken 60% right decisions, Okay, I have that number. Maybe he's delivered a 15% per annum return. On the other hand, I have a fund manager who's taken 45% right decisions, but he's actually delivered a better return than the first fund manager. Now it's very simple. If I'm trying to look for consistency, right? I want a Rahul Dravid or a Sachin Tendulkar, not a Virendra Sehwag. You know, it's just drawing an analogy that somebody's got a more consistent performance is what. So this is one example of something that we would look at. And of course, you know, it boils down to again, like why do we go to mutual fund managers? One of the big reasons we go to mutual fund managers is because they research companies and not just doing paper research. Right? Would you put money with a fund manager who only says I pick stocks, reading newspaper articles, online, you know, articles, reading magazines? You won't.
Or follow chats.
Or follow chats, or chat groups, WhatsApp groups, and WhatsApp groups have become very, very popular. You know, the best fund managers have their ears on the ground. They're talking to companies, suppliers, distributors, company, you know, competition, private companies, and they build a 360-degree view. And so at one level, while we look at all these numbers, we also talk to the entire teams of these fund management teams. And then you sort of, you know, combine and build a 360-degree view. It's not to say we can't go wrong, but really what you're trying to do is build a combination of 6, 7, 8 names. And if your objective is clear, then it's not too difficult to build those 6, 7, 8 names.
Right, Feroze, hence I think it can't be on an ad hoc random basis, right? You've got to be clear about why you're investing, what your objective is. So it comes down to goal-based investing. You want to add to Amit's list and tell us a little bit more about what your team does while they determine what is a mutual fund that one needs to invest in? How do you put your recommendation list? Because I do know that it's not ad hoc from the little that I understand myself.
Correct. Of course, Samina. I think firstly, one is selection. Before that, we firmly believe that innovation of products in India has not happened for the client. Okay, it's a very large statement to make. If the simplest of the product has made returns significantly more than most of our people's aspiration, 15-17 mein log khush hain, and simple product has made that.
You know, I think popular belief, right, is invest in mutual funds through the SIP route. It helps create wealth. You can invest as little as 500 rupees a month and still, you know, of course, build an investment portfolio. From our drivers to our staff at home, everybody is going with this mutual fund wave. So we get why this works for a retail investor, because one, we don't have the time or the knowledge or the quantum of money that you would require to get a specialized or concentrated advice. Is it a perception? Is it right? Is it wrong? I'm going to ask you this, Amit. The perception is that if you're an ultra HNI, you already have access to the best guys in the market, right? The best fund managers, the best wealth advisors will be chasing you to give them your wealth and help you manage it. In a case like that, should those ultra HNIs also look at mutual funds as an investment tool, or do they have access to, say for instance, a PMS, or you know, just a direct equity portfolio, which would probably get them better returns?
So I'll give you, you know, my own personal context. You know, I started the institutional equities business in Anand Rathi. For 3 years, I was doing equity research. I met 200 companies across the country, factories, promoters, etc. Continued to advise clients. At some point, very quickly in the game, in 4 or 5 years, I realized that mutual fund managers are sitting in a position, just gaddi pe baithe hain. Their access to knowledge and insights is far greater than what I might be. And I'm here sitting as a MD and CEO of a large financial institution, and I don't have the wherewithal. I might be brighter than, I might consider myself to be brighter than somebody.
But it's the access.
But there is just access to, you know, so I have, let's say, as you know, we have 25 people doing equity stock research on a full-time basis. Now for a fund manager, he has 50 brokers like Anand Rathi. So 50 multiplied by 25, you know, he's got about 1250 people giving them ideas at all points of time. So I think they're in a far better situation. Second, you know, all stock ideas also, there's a perishable, you know, it's a perishable commodity. So if I call up a client and explain that idea, you know, first, and explain to somebody after 10 days, the person who gets the idea after 10 days would have been buying the stock 20% higher. Right? I realized this very early. My own personal investments are, you know, to the extent it's for long only equity, it is only mutual funds.
Feroze, let's compare PMS to mutual funds, right? Because a lot of us would like to feel special. We all have this massive ego that, oh, you're an ultra HNI, and of course you get specialized treatment, you get the frills and the thrills, like you said, a platinum card, first class, business class lounge, all of that, right? But beyond that, a lot of people also fall for this PMS gimmick where they feel like because it's more concentrated and it's more catered to your needs, it might be better for you. And the fact that a lot of retail investors don't have access to PMS, ultra HNIs believe that this is probably a better tool of investments. But is that true? Do you think, how does PMS score against mutual fund? Do they deserve any sort of, footage on your portfolio?
Point one is, in my opinion, the answer is no. PMSs don't score over a mutual fund. And unfortunately or fortunately, we're in the business of mathematics. And mathematics should take the decision, not my bias or anybody else's bias. Now let me tell you, largely, we all have a syndrome which is called the fear of missing out. So every time we're doing something right, somebody comes and makes us feel that I'm missing out something. Right? That's in the youngsters lingo, it's called FOMO, fear of missing out. So I'm doing well, I'm meeting my target, somebody comes and tells me, why are we not doing a pre-IPO fund? But then when we analyzed, and if you look at data, 2006 is when private equity funds were launched in India. I'll come back to the PMS question. I extracted the presentations which were made in 2006. Everybody was expecting 22 to 25% post fee. The average return of all these funds, not little, 80% of the assets, it is not two funds, 80% of the assets had a 6.3% weighted average return in a 10-year period, right? And the kind of value destroyed, if it was in mutual fund, it would have been enormous. Point two, like pre-tax and post-tax. One of my clients asked me to analyze a 4 crore investment invested for builders, lending. Money was lent at 21% to builders. All builders surprisingly paid back in time. Okay, and the post-tax, post-expense return, I will not go into why it happened that way, was 9.3% without a default. All that was there for us to see on day one. July 2011, the product was launched. It had a 21% expected return. There were 5 reasons why it got diluted. It is not because somebody didn't pay the money. After they paid, there were carries, taxes, there was IRR dilutions, so it came to 9.3. And in July 2011, the safest product, which is called a AAA rated fixed maturity plan, was giving 9.7. So I'm just substantiating Amit's point with some numbers. Okay, and this is not a small fund. This was a 500 crore fund managed by one of the large banks, real estate wing. So the point I'm trying to make is you will have to look at the number before you take the decision. Now coming to PMS and mutual fund, there my only humble submission to people who consider investment in PMS or have already invested in PMS is to see whether investment has one side to the coin or two sides. It has two sides to the coin. One is return, the other is risk. Most people I have casually asked, is risk important? I get an overwhelmingly positive response of yes, risk is very important. Then the point which I will want people to consider is, if risk is important, we are only measuring return. Where is the measurement of risk? Statistics has 4-5 very strong measurements of risk. लोग कहते हैं मेरे लिए रिस्क बड़ी इंपॉर्टेंट है, बट मेजर कर रहे हैं सिर्फ रिटर्न. रिस्क मेजर हो सकती है, सिंपल एक्सेल शीट पे रिस्क मेजर होती है, स्टैंडर्ड डिविएशन कहते हैं उसको एक रिस्क मेजरमेंट को. सो व्हेन इट कम्स टू पीएमएसएस, रिटर्न कुड बी 2% हायर समटाइम्स, बट देन व्हेन आई लुक एट रिस्क measured in standard deviation, Nifty standard deviation for the last 20 years is 13. I'm just putting a benchmark so that you have a context. PMS standard deviations have been 20. Mutual funds, there are several mutual funds at 11 standard deviation, 10 standard deviation, Nifty se come. So when it comes to PMS, I urge people to look at both sides of the coin, look at the relative risk as well, and then see it in a context, and at least on a risk return basis, a PMS doesn't fare.
What about the other alternative investments? So maybe private equity, because a lot of the wealth is now coming in from the likes of a Flipkart or Paytm, where it's not in the listed space. And I think a lot of us are getting carried away by investing in unlisted space, doing a private equity investment, doing a real estate fund investment. Some of it does yield returns, and I'll give you an example where we invested in a private equity fund, made a lot of money, but it seems like 8 years later we still can't cash out at market price. Of course, a lot of us miss the fine print when we invest in a private equity for that matter. So while there may be some that will work for you and that one needs to work to sort of make up for the others that don't, entry and exit into these complicated alternative investments is actually enough to put an ultra HNI off, or should be enough to put one off.
Yeah, I think, that's one element of risk that we don't consider. So, your question two parts.
Yeah.
No, not the fine print, it's really about the liquidity angle. So not having money at your disposal in 48 hours to us is a risk. Because if it's my money, I've invested somewhere and I can't exit it, right? How many cases we know of family situations in friends where there's some property which is, there in the family, jo pushto se chali aayi hai, it's been sitting there, there's a dispute, it is worth 100 crores plus, there are 1-2 family factions who don't have enough money for a decent lifestyle, they're hoping when that property will get sold, but there are disputes, courts, cases are going on for 10 years, 15 years, they're talking to various builders, developers, it is stuck. The money is there, but they can't access it. So I think putting a value to liquidity is something that we all miss, and I think in a lot of the alternatives, one of the first things that I would consider is saying, if my money is not liquid on demand, it is not my wealth. Then I'm really...
So it's only your net worth.
It's only my net worth, it's not liquid wealth. So for us, liquidity is a big criteria. Then coming down to, a lot of these temptations around startups, venture capital, yes, there's a Paytm, yes, there's a Flipkart, but, in the markets, a lot of people, talk about, we really respect, there's a Rakesh Jhunjhunwala. But for one Rakesh Jhunjhunwala, there are probably 1 million who failed, or 10 million, who failed trying to become, in economics, it's called survivor bias. So yes, there will be few successful people, but for that one success, how many people, were trying to build a Flipkart in India? My guess is probably 10,000. Right? Of the 10,000, there are 1 or 2 that made it, even a Snapdeal faltered and, came off. And end of the day, until you can't encash it out, it's only a value on a piece of paper. So, having said that, it's not that there is no case, maybe globally, where returns are low, people, or even in India, if people have a return target which is exceptionally high. So today, if I have a return target of 20-25% is my goal, and I believe I want that goal and it is needed for me, then sometimes you have no option but to look at more risk products. But the challenge we've seen is that most people actually don't have those goals and they end up doing those products. That's the dichotomy. So, right, if we are able to be first sit down and spend 1 hour thinking about what is my goal as a family.
So it comes back to goal-based investing.
Absolutely.
And keeping it simple. Feroze, what is I know we shouldn't be going by past performance, but in the last 2 decades, what is the alpha that mutual funds have created over, say, just buying the Nifty? Or just buying Nifty Bs, yeah. So just simply buying the index versus going for a mutual fund, what has been the alpha created?
So, alpha in the technical nomenclature is nothing but the extra return I make because somebody else is applying mine and giving us more return. So the alpha is created in the sense if the market gives 10, what can I expect in the future is point 1. What has happened in the past is if the market gave 10, mutual funds, good mutual funds would have given 16, 17. So there is 6-7% extra return which is coming because of somebody's intellect and capability. Will that remain so large, which is the more important question for us to ask as investors, is to say the future might not be as bright as the past. You can expect 3 to 4-5% more than the market. Now this is very, very prominent that in the emerged country, people don't use human beings. They only they buy the market itself. Those are called exchange traded funds. Now there are a lot of debates I have been a part of which says India is already going that way, saying that there's no point having a human being and paying him a fee because he will not be able to beat the market. I think we are at least 7, 8, 10 years ahead for that argument. Because there is enough imperfection in this market for the fund manager to create that alpha. Now let me put this in context. SEBI's latest rule or notice which came to mutual funds in October 2017, even if you have 1 rupee in mutual fund, it's very important to read this circular because this can change the dynamics of there can be a paradigm shift, not an incremental shift, a complete shift of how mutual funds will be managed. It's a SEBI circular of October 2017. Why am I saying alpha is possible? Alpha is possible wherever there is imperfection. If US is 50 years, 70 years ahead of us, their alpha is not possible because they are very, very quick in information. Information dissipation is like milliseconds to everybody. In India, if you look at the SEBI circular, it's a little surprising to me. It says that 250 companies is the largest money beneficiary of the mutual fund. Top 100 companies of this country will be called big companies, large companies. The next 150 will be called mid companies. This means that in this big country of this quantum, there are 250 companies which will get the maximum money allocation from mutual funds. And these companies will be chased by almost 4,500 crores every month from the systematic investment plan. 4,500 crore हर महीने, at least अगर आज के आंकड़े देखूं, will go into 250 companies, and that 4,500 crore will keep growing because 5 years back that 4,500 crores was 1,000 crores. So this kind of money is going to chase 250 companies, which is not even, which is held largely by promoters also. It's not even free float. So the point I'm trying to make is, in such imperfect market of a very large size, 250 companies being beneficiary itself is a dichotomy. That I would see, if I was a fund manager, I would see that as a big opportunity to create alpha for myself. So will the alphas die down? Because every time mutual fund slips for 6 months, like last 6-8 months has been very bad for mutual funds, extra return. Everybody starts debating that mutual fund ki alpha khatam ho gayi hai. I think we are little away. Why will I will drop a comparison. In 2013, the exact same thing happened, incidentally, and the subsequently 2014 funds have beaten the market by 20%. So if somebody concluded this in 2013 that I should go for market funds, not human intervention, he would have lost a 20% alpha in the subsequent year. Whenever mid caps and small caps get rogered, mutual funds don't create an extra return. That's the phase we are in. If somebody tells you that we are done with mutual funds alpha, they might not have looked at 2013. It needs to be seen.
I know this is more topical as opposed to more in terms of creating a, giving our viewers and our audience a sense of investing in mutual funds. But like Feroze alluded to this, in this month we've seen record outflows from mutual funds, not just from local participants but from foreigners as well. Inflows have also dropped down substantially, and all this when the markets are sitting at a record high. Why is that happening, Amit? If all is well, you've got a solid government in place, you're going into election year, the monsoon is in place, inflation is in control, of course the rupee is at 72, but barring that, everything on the face of it looks healthy. Earnings season wasn't too bad. Why are mutual funds not being able to attract the kind of inflows when all of us do strongly believe that that's the best advisable route for one to undertake?
I think that's a problem for the mutual fund industry to solve. I think it's really the lack of advisors, because what we've seen is that a lot of people were doing SIPs for a period of time. Some of the SIPs have slowed down because people have not seen returns for 1 year, because the markets have, I think what's also happened is that, again, it comes about greed and the right sort of asset allocation between large caps and mid caps. So people aggressively went into mid caps, small caps, and that's where we've seen a big correction in the markets in the first half of the year. So while they've stabilized, most people are sort of sitting with no returns or negative returns. And I think comes down to saying that did we have the conviction when we enter the markets that we are doing this for a 5-year, 10-year period, or were we chasing short-term returns? So I think this is a sort of herd mentality that we'll see around the world, and to an exaggerated extent in India. And there is, for smarter investors, there's actually an opportunity, because on the ground the economy seems to be improving. You look at corporate results, leave aside 2 sectors, real estate and gems and jewelry, 2 major sectors. I think across most other sectors we are seeing a significant rebound after many years, and we haven't seen this sort of growth, sort of broad-based growth, for a while. So on the ground the economy is improving. Politics is what it is. In India, I think our view at least is that businesses work despite the government. whether it is UPA, NDA, वो चलता रहता है. Short term there are shocks, but businesses find a way to function in spite of.
And I think the reality is you got to look at a long-term story. You can't.
Yeah, and India, entrepreneurs figure if how difficult is it to find 40, 50 smart entrepreneurs who will navigate their way over a 10-year period and build a great business. So I think it's not that difficult. It is just about having the patience. I think on the ground, the economy seems to be doing well. Like I said, there are some factors like oil prices, interest rates, which are bothersome. But I don't think it changes the dynamic of what we're seeing in India right now, because the kind of entrepreneurial activity that we're seeing in India is unprecedented. A lot of people sitting here, can look back 20 years back, in the mid 90s or 80s, the thought of becoming an entrepreneur itself was a difficult call. But today, any kid out of college, essentially, you're seeing the kind of, a lot of these entrepreneurs will fail. A lot of businesses are being created. But I think entrepreneurial activity is what, if you look at a country like the United States, that is what has brought the country there. So I think we are seeing unprecedented entrepreneurial activity, and which is, which makes me very optimistic on the prospects of where our country could be, an economy could be over a 10-year period. Now, it doesn't mean we predict what will happen over the ground. We're seeing good
and we have a great consumption story, which is what the US was built on 20, 30 years ago, right? Feroze, recently there are so many articles that I've come across which constantly talk about direct mutual funds. Now, of course, there are two types of mutual funds, right? You've got the direct mutual funds and you've got regular mutual fund schemes. Regular mutual fund schemes have a higher expense ratio and hence your NAV is lower. What regular mutual funds do is, of course, they have to pay out a distributor or an agent who's the in-between man. Now, I know till a few years ago, you needed that in-between man for processing documents, apart from the advice, of course, which is most important, filling your KYC, getting your documents in place, making those investments, you needed a distributor or an agent. Now, of course, with everything going online, the need of a distributor for doing the ad hoc documentation is not required. You largely need them for advice. Now, you also have a lot of independent financial advisors who are in the market, who strongly, probably talk to a lot of our people in the audience, where they say that you can, we pay you an annual fee, advice-based fee, and you go ahead and do a direct mutual fund, because then you save on your expense ratio. Now, does that make sense? I mean, I know we're trying to cut corners here, but it's being penny price pound foolish, isn't it?
Yes, maybe not, but I think it's very, very important for all of us to understand as mutual fund investors, if you are not already aware, that there are two methods to invest. In the same scheme, you can cut the broker or your advisor and save your cost, which is called the direct option, as the name suggests. For the benefit of those who are not aware, I'm just making them aware. So every scheme has a regular option, has a direct option. Okay, so there is a difference of 80 paisa to 1%. Now, great. So if I'm getting good advice, then this 1% difference, which becomes the advisor's commission, that actually gets, now in my case, for Anand Rathi, that is the commission which we get, and to be transparent enough. So if you removed your advisor, then you save this cost which was supposed to be paid, right? But there are some advisors who actually allow you to reduce the cost and charge you a very small fee, 20 paisa, 30 paisa, half of it, and help you save half the cost. But the point is, I've analyzed several portfolios on that format. What people do is, fortunately or unfortunately, some of these companies who offer this service at a reduced cost are listed companies. So their profitability is there in the marketplace for me to judge. Then I see people give you a discount on mutual fund commission, and then they use that 20-30% of exotic products to make 2-3%, 5%, 7% upfront commission. It is like going to a theater and you have paid lesser for the ticket and you are paying so much more for the popcorn and Pepsi. That's exactly the model, and it is provable. That's why I'm saying it on a larger platform. Okay, so what happens is you're using transparency to create opaqueness. That's ironical. The rule has been there by SEBI to say, be transparent, tell the client that I was making this. If you want me to bring the cost lower, you can make it lower. So the entire purpose of the regulator was to create transparency, and 80-90% of the portfolios I analyzed, there is a component extra than mutual funds where the commissions are 10 times more, 20 times more than
So
30%.
who should be looking to opt for a direct mutual fund scheme? I'm sure there is a section in society which should look at that, that route of investing, right?
See, there are two schools of thought. I come from one school of thought. If you think your advisor doesn't deserve 1%, go find the advisor who deserves 1% rather than going and finding how much he deserves. If we have to make 16 together, whoever can help me get the 15 is more important, because by playing around with this one, what can you do? You can play around half. So what I'm saying is, quite a few customers or investors try and find out, what does my advisor deserve? How does it matter? Go find another advisor who deserves 1%, and I'll tell you why it is important. Okay, and that's where I'm giving this analogy. Equity mutual funds, for example, the best and worst equity mutual funds we analyzed for the last 25 years. Best one and worst one have given how much difference every year? 25% different. Matlab, if you went into the best fund and worst fund, the difference is 25. In that 25, if I got one scheme wrong, मेरे 20 साल की मेहनत जो मैंने पैसे बचाए थे ना, वो पूरे एक झटके में चले जाएंगे. Now, let me give you an example of the recent one, SBI Magnum Mid Cap Fund. Okay, in the same SBI basket, there is another fund. Like my team was fortunate to catch this trend sooner. 1.5 साल पहले, they said SBI Magnum Mid Cap sell. Go into another fund of SBI itself, which is managed in the same fund house. The difference is 22% in performance. I might keep saving 0.5% every year, but 1 year, one wrong move can take away 15-20. Because the best and worst are too different. So पूरा दिमाग लगा के करना जरूरी है मेरे हिसाब से. Of course, this might seem like vested interest, saying that advisor के पेट पे मत लात मारो, but it's important to make sure that you get an advisor who deserves that 1%.
And I think it's only fair, right? I mean, everyone's here to make some money at the end of the day. There's no free lunch and there's no charity at the end of the day. So if you're making it on a fair, on a fair sort of basis, and where it's transparent and you're creating wealth at the end of the day, then it doesn't matter if your advisor is making money, because otherwise you're going to find loopholes to make that money, and that's where the problem then comes back.
It's the same analogy. If I'm going for a treatment, I go to one doctor and is not able to give me a solution which cures me. I don't discard the doctor and go to the chemist.
Correct.
I will go to the second doctor, third doctor, fourth doctor till I find the right doctor who can
willing to
pay. I think it's the same analogy, right? Because the market is still, there is a solid need for advice, and we genuinely believe there is need for advice. It's about customers making the effort and saying, you know what, let me not be penny wise pound foolish, and actually figuring out.
And only when you're going to be making money do you have your own vested interest, then that becomes a vested interest of the client creating wealth, right, at the end of the day. Let's move on to taxation, because I think you alluded that in your speech as well. Taxation is probably the only free lunch, if there is any in the market. Come in on this one, Amit. How tax efficient are mutual funds, as versus alternative investments, versus direct equity, versus any other asset class or product?
I think even despite with the last budget where equity mutual funds got into the tax net on the long term side, despite that they are still the far most efficient mechanism for investing in equities and in fixed income, both on the bond side and on the equity side. So let's not just stick to equities. The simple thing about equities today is, let me give a very simple example. Today, any portfolio manager or as an individual investor, if I have a portfolio of 20 stocks, 30 stocks, 40 stocks, there are a lot of stocks which I might have to book gains or trade within the year. There are very few stocks today that you can say I will buy and sit on them for the next 5 years, because sometimes prices run up. Might be a great company, but the valuation is completely, you think that it's completely, the valuation is, sort of gotten to the maximum point. You might reallocate your sector allocations because some sector has grown to a very large number from a risk management perspective. Now all those trades in the individual name or in a PMS format will get taxed at short-term capital gains tax. With mutual funds, mutual funds can trade every day if they wanted to, not that they do. But if you hold it for more than a year, you're on the long-term capital gains tax. And if for investors who are able to hold this for really long periods of time, the ability to defer this tax till the point you exit, that compounding effect of the tax saved actually becomes substantial. Right? So there are multiple ways and mechanisms, but this is a very simple way to sort of look at one angle here. But I think it is still by far
the most tax
the most, and the government has given it a preferential treatment, essentially to encourage people to. And while we have it, we should use it. In the US, it's not like this. In the US, if one buys a mutual fund, every trade that the mutual fund does, end of the year they send us a statement that we have done these trades on your account and you please pay taxes accordingly. So understand that, for the most biggest capital market in the world, there's full tax, there's no differentiation. But in India, the governments have actually given us a preferential treatment which we should take advantage of.
Also, very lastly, we'll of course then open up the floor for questions. But Feroze, in terms of I know this is tough and this is more specific to your client, but an ideal sort of, close to ideal sort of portfolio allocation across equity debt. So how much of your portfolio should be in mutual funds and how much of it should be in other sort of distractions like maybe real estate, private equity, hedge funds, unlisted stocks? What is ideal, and even in the equity mutual fund space, what should go into large cap, how much could be in focus? Just give me a broad sort of portfolio that would be ideal if you had to meet a client.
Wonderful. Before I go to that topic, if I can add one point on taxation. Unfortunately, we don't think that taxation is something which we have to learn. Investment taxation is basic taxation. What does Section 73 say? It is important for all of us to know because our monies are there. If you just spend 2 hours on taxation, you will at least know the basic taxation. Why is it important? For example, in debt funds, now that we are speaking of mutual funds, you get something called indexation. Matlab, inflation बढ़ती है, तो you get a tax discount. महंगाई जितना discount मिल जाता है आपको, उसको कहते हैं indexation. महंगाई जितनी है, उतने पे tax नहीं भरना है. Now if I ask people what is the index, okay, you will be surprised. I'm just highlighting to you how much is there for us to just pick up. Inflation index was 9%, it came down to 5.8, it came down to 3.93, it came down to 3.03, last number is 2.9. Okay, if you are a debt fund investor and if your advisor has so far not told you that indexation has come down from 9 to 2.9, and your tax benefit on debt funds is almost finished because of indexation, that means you have not written your objective. Unless you put your objective saying, Mr. Advisor, it is your responsibility to look at taxation. If it is not written as objective, why is he responsible or she responsible to do it? So put that as your objective, saying that tax efficiency is wealth manager's objective. Now, how many people actually know that, I think it was 2016 budget, several ancestral properties have become zero on capital gains. By just one statement made in 2016 by Arun Jaitley, most of South Mumbai properties are tax-free today if they sold. So point one I'm making on taxation is, of course mutual funds are tax efficient. But I think it's for us to introspect whether taxation is a wealth management objective or not. If you put that as an objective, you will be able to put your attention to it. I have met a gentleman who has maybe triple-digit crores in debt funds. Triple-digit crores in debt funds, but he doesn't know that the index has come down to 2.9. Because the objective of the wealth manager is not aligned to taxation. The second analogy, second highlight I was doing, which has not come to most people's attention, is a small statement made that the index year has been changed. There's one gentleman who bought a 1 lakh rupee in Bridge Candy villa, which he is selling at 30 crores. Before 2016 February, he had a tax of 6 crores. After 2016 February, if I actually sat down and made the computation, he has a negative tax. Matlab his tax has become zero and he gets a tax benefit somewhere. But he didn't know. So please put tax as an objective. Then the propensity for you to meet that objective will go up substantially, is what I want to close that. How much and where should it be allocated? In our opinion, there are two growth assets, real estate and equity. Amit has been negative on equity for the last 4-5 years.
Real estate.
Real estate, not on equity, sorry. So you have two growth assets, equity and real estate. 5 years back, we've written articles, we have done whatever we can do to create awareness or an opinion. Today, people have come to terms. 5 years back, when we said real estate is writing on the wall that it will go down, we used to have debates of 3 hours before we concluded that actually real estate is going to be down. So now, real estate will have another 2-3 years of lull, in our opinion, easily, 4-5 years more. So that leaves us with only one choice, unfortunately, equity and debt, which is also a very good thing in India because you have interest rates at 7, 8, 9%. So we have to enjoy that interest rate. If we were Japanese, we would have had 0.5% interest rate. So creating stability using debt is a good idea. So point is 65% in equity for long-term monies and 35% in debt. In this, we only recommend 2 instruments, and this is what we have done for 6 consecutive years without change, is mutual funds and one relatively more complex instrument called structure products. So equity, debt 65-35, structure products should be 35-40% of your portfolio, 60% should be mutual funds. Large cap should be 50%, not more than that, because the new large cap definition is so conservative that you will not make too much money if you don't go into mid caps. Mid cap in the erstwhile regime before 1st April were very aggressive. Now they've made it conservative. So half your money should be in mid cap and small cap, half your money should be in large cap, because before this regime, people used to call a 5,000 crore company as small cap. Now, more than this 250 companies, all of them are called small cap. That means SEBI has made all the products very, very safe. So if you superimpose safety over safety, your return will get compromised.
We'll start taking questions from the audience. So anybody who has a question, would be great if you can stand up, tell us your name, let the camera pan on you and then take the question.
I am M.K. Mittal, I am Director of Finance of NSPC. My question is, like, if we see that the total profitable companies in India, if we take out, the average return on equity may be 10%. Average return on equity may be 10% for all the profitable companies. Leave aside the loss-making companies. And if you consider the loss-making companies also, the overall return on equity may be even less, maybe in the range of 6-7% only. So my question is that how we can target a 15% return on equity or 15% return on the investment when our real return on equity is only 10%, number one. Number two, if I pick up the companies whose return on equity is 20% or 25%, then I'll have to pay higher price for the shares. And basically the book value is say 100 rupees, return on equity may be 20 rupees. If I buy that stock, I may get it for 200 rupees. So average return on equity won't exceed 10%, even, you know, with that kind of market price. So if I am getting a higher return more than 10%, that means it is a temporary phenomena. On a long-term basis, I should not get a return which a company normally earns, because you can't earn something extraordinary. The wealth being created by the company can only be transferred to the investor ultimately, right? So if you are getting some return which is additional, it is a temporary phenomena, it's a bubble, and tomorrow your stock price may come down and ultimately you may end up in getting a return which is equivalent to the return generated by the company. So that is my question.
Sir,
thank you.
So Mittalji, you know, relevant question I think, but it is a technical question. So 2 quick things to that. One is, I don't know where your data points are, maybe we can have that discussion offline. The return on equity for the investable universe for the institutional investors, largely the top 200 companies, is close to average between 16 and 18%, 19% is the return on equity. And these are the companies that most people are investing in. India is actually one of the highest ROE markets globally. And maybe one reason is because it's difficult to do business in India. So people who become successful actually have a much higher return on equity. So India actually has a return on equity which is 16 to 18%, and if you see in the last 25-30 years, the markets have also delivered that same return. The second part of your question was related to valuations, and again there are two aspects to that. So one is it's probably a full valuation discussion around valuation theory, present value of future cash flows. It's a discussion I think we can have again offline. I think it's a decision therefore which is best left to professionals to make that call. I'm not saying that that a number of 200 for a stock is right or 150. There are people who have the expertise to make that call, right? And because it's I'm a student. When I did my MBA, I studied under one of the so-called professor gurus of valuation in New York City, and till today I'm still learning. There is so much to learn. So there is no, unfortunately, valuation is not a mathematical construct where you can say A, B, C, answer equals D. It's an ongoing process, and it has to take into account so many factors. So it's a discussion which you can offline, but that's why I believe that even despite having all the expertise, sometimes somebody who's doing that job on a full-time basis has the required expertise. It's best left to them, because 25 years in India could not have been temporary. 50 years, 100 years across the world could not have been temporary. Right? We've got so much track record. Yes, tomorrow the world might end, things might happen, but I think there is enough track record there, and we can have a discussion offline. I think it'll sort of bore the rest of the audience if we get into a technical discussion. I have a very simple this thing that you need Superman to do timely entry and exits, because in timely, when people talk about timing the market, right? There are when you time the markets, we are talking of doing two things. One, we have to buy at the right time and sell at the right time, or sell at the right time and buy it back at the right time. So you have to make two decisions. The probability of any investor making decision right on average is 50%. Let's talk 50% of right हो सकते हो, 50% wrong हो सकते हो. दो decision लेने हैं आपको. The probability of getting both the decisions right is 0.5 into 0.5, which is actually 25%. And most people who want to time the markets actually end up timing the market. You have to time it for every 10-15% move. आप साल में 2 बार करोगे. So over 3-4 years, your actual probability is single digits. So what we've realized is that trying to time the markets is not necessarily it's aspirational. We haven't seen many people do it consistently. There will be some extreme points which you get over a 5-10 year period where you can say, oh, markets are at such low levels that is great time to enter, or markets at such a high level, it's a great time to sell. You might get those points, but on a regular basis, I have seen most people struggle. There is no science to do that. What we found is that instead, if I see the trend of the market itself, play the probability that if any day I invest, 2 out of 3 times the market in the last 30 years has been up over a 1 year period. Over a 10-year period, 95% of the time markets have given a double-digit return. Then why am I not playing that game? So for example, I'd like to draw a cricket analogy. If I can bat in Chennai, Chepauk Stadium, and score a century every day, why would I not bat in England where the ball is swinging around? So timing, aspirational, yes. A lot of media talks only about short-term targets, stop loss, etc., etc. But honestly, in my experience, it's a mug's game. Nobody makes money in that process. In fact, the markets have a great odds for people who have a longer-term view. And fortunately, for a lot of HNIs today, we have the ability to take a long-term view. So, which is what I urge, people that please take that long-term view. Let's not play this. If there are extreme events in the market, yes, one can consider. But on an average, on a daily basis or regular basis, I don't see an opportunity for sort of trying to time the markets.